Dr. Hatzius joins us this morning. Jan, thank you for joining Bloomberg Surveillance. You guys shook the world with a markdown yesterday on GDP. If we get stimulus from President Biden or a second-term President Trump in January or February, how will you adjust?
It's good to be with you, and you're obviously being way too kind there. But in terms of the outlook, we did take down the fourth quarter because of the reduced likelihood and very low likelihood now of a fiscal deal. We were at 6% quarter-on-quarter annualized. We're now at 3% quarter-on-quarter annualized. In fact, a few weeks ago, we had considered a larger downward revision than this in the event of no deal between Democrats and Republicans. But we ended up with a somewhat more moderate downward revision in light of the fact that the end of the $600 per week payment to unemployed workers at the end of July doesn't seem to have had as large an impact on spending as we had thought. So it seems like the consumer is still holding up reasonably well, but nevertheless, a downward revision was necessary. Now, if we get into 2021 and we have another fiscal easing under President Biden with a Senate majority or under President Trump, then we would upgrade our numbers probably, because we're not really building in a significant amount of stimulus from here. We think there are other reasons why the economy may do pretty well in 2021.
Right.
They're mainly related to, COVID developments and potentially a vaccine, but we're not building further stimulus at the moment.
Yeah, and your initial acclaim came off mortgage equity withdrawal and looking at the behavior of consumers in the housing boom of 04, 05, and indeed into 06 as well. What is the behavior of consumers that you and Goldman Sachs see right now?
I think the main constraint on consumers is really the development of the pandemic. I mean, that's the reason why the economy turned down so sharply in March and April. And to the extent that we can unwind these losses, I think it's going to reflect improvements in our ability to cope with the disease, to reduce infection risk, and ultimately to come up with a vaccine. That's at the top of the list for me. But of course, income plays an important role as well, and government programs to shore up incomes during the worst part of the pandemic, I think, were extremely helpful. For me, the most amazing statistic of this entire period has been the fact that the second quarter saw the biggest decline ever in real GDP, going back at least to 1947, but also the biggest increase ever in real household disposable income. That was really key, I think, in turning around the downturn of March and April in subsequent months. But of course, this story isn't over yet. And right now we've seen a setback, it seems like. And what happens to fiscal policy as we go into 2021 is going to be important.
Well, Jan, that's the issue. And Bob Prince over at Bridgewater has talked to us a couple of times about the duration mismatch. This pandemic will go on for a whole lot longer than the 3-month Band-Aid that the fiscal authorities keep applying. And I just wonder, from your perspective, we managed to offset that income crisis, that income shock of 6 months ago. Do you think the nature of the slowdown changes if the appetite to apply another fiscal Band-Aid isn't there?
I do. I think there is a very strong case for keeping policies, both on the monetary side and on the fiscal side, very accommodative. I'm generally on the more optimistic side of the debate as far as the economic outlook is concerned these days. And I do think that we're making significant headway. But at the same time, we're clearly still very far away from full employment. The pandemic is definitely not behind us, and the economy still needs a lot of support. So on the monetary side, I would say I'm pretty comforted by global central banks' willingness to continue to provide support. I think there's a very strong consensus there that the economy is still needed. But on the fiscal side, of course, it's a more political decision, and especially in a hyper-politicized environment as what we have currently, given the impending election, it's much easier to see a setback. And clearly we have just seen a setback. And I think it would be very helpful if we could get another round of support.
What's interesting about your call, though, Jan, as you cut growth for the end of this year, you boost growth for Q2, Q4 at the back end of 2021. There's some people out there, some economists who believe that if we don't grow quickly enough now, the potential growth in the future has to come down as well. What is it that you see that makes you think that even if growth has to come in the near term, it can pick up in the longer term, or at least the medium term?
Well, I think that if you're restoring less activity in some of the sectors that have been hardest hit, the consumer services sectors like transportation and restaurants and areas like that, that does give you somewhat more upside potential further down the road. Eventually, I think these sectors are going to normalize, especially in an environment where the pandemic is just less of a threat, perhaps because a vaccine is available and will have been broadly distributed by the middle of next year. So I think it's sort of natural to offset at least a part of any near-term changes in your growth forecast with changes in the opposite direction, a few quarters down the road. And I think in this case, that strikes us as the most likely outcome. Although, of course, there's a lot of uncertainty about what happens further down the road. And I think also that the idea that if you have a larger hit in the near term, that can weigh on your ability to restore activity much further down the road because of scarring effects. There's something to that as well, but I think that operates on a somewhat longer horizon probably.
Jan, let's build on this, because when you talk about the potential for faster growth in 2021, even as we see slower growth now, that also flies in the face of the market's expectation for inflation. One market aspect of this week's action has been a steady drip lower in 5 to 10-year inflation expectations. Do you think that the market is wrong and that the Fed is right in thinking that they can get 2% inflation in the near term?
Well, the Fed doesn't have 2% inflation for at least the next couple of years, so it still takes a while. And I would agree with that. I think we'll be below 2% for core PCE inflation for the next several years. However, right now we're at 1.2% for core PCE inflation, and I think a significant part of the gap between that 1.2 and 2 is probably related to more temporary factors, basically distortions or disruptions rather in the most COVID-affected sectors. I think that is going to unwind over the next year. I think that is going to push inflation higher, but maybe to the 1.5 to 1.75% range. So you're still below where you would want to be and what would be needed for the Fed to even think about hiking rates. But I don't think you're going to be quite as low as where we are now. As far as markets are concerned, inflation markets in particular, yes, 10-year CPI inflation expectations or break-even inflation rates of 1.6%, that does strike me as low. And it's moved lower, as you say. And so I would say I'm disagreeing a little bit more strongly with market pricing on these break-even rates than I did, say, a couple of weeks ago when it was a bit higher. I think there's some upside there.
This is crucial, and this is one of the most heated debates on Wall Street. BlackRock coming out and sort of speaking to the debate that John and Tom were having earlier about the rejiggering of supply chains in the wake of the deglobalization and how that alone could really increase inflation perhaps more than markets are expecting. Why is that not a thesis that you follow based on your expectation for 1.5 to less than 2% in the near term for inflation?
I think it's a factor. I think it's going to be potentially a factor for the goods sector of the economy. But I also would say that the service sector is significantly more important, accounts for 70% of the basket. The goods sector only accounts for about 30% of the basket. And also the potential impact of changes in supply chains, I think it's going to be spread over a period of time. I don't think it's something that is going to have, a huge impact in the very short term. But what does have much bigger effects in the very short term, I think, is these distortions or disruptions that we're seeing in COVID-affected sectors, which are probably going to unwind more quickly. So, I think both of these factors are probably reasons to expect somewhat higher inflation, but I think the disruptions are more important.